Sensei here, and if you made it this far with my previous videos, you're obviously trying to narrow down the level of risk that you're willing to take with your plan A. And you want to have as much information as possible before you make your move, which I commend. So when we look at a continuum of financial tools and how they relate to risk, if you place all of your money in the stock market, that degree of risk is at the high end of the continuum, as opposed to placing your money into a whole life policy, essentially at the low end of the risk continuum. In my last video, I was discussing how universal life insurance emerged out of the need of having more flexibility regarding the contractual agreement between the insurer and the insured. To create this flexibility, the insurance company had to unbundle some of the risk that it had been managing for over 170 years via whole life insurance and place that risk into the hands of the policy owner. By making this shift, it allowed premiums to become much more reduced. So a whole life policy was a policy that was essentially set in stone. You paid your premiums, which essentially went beyond the cost of insurance for your current age and health, locking in your rate for the life of the policy. This, of course, allows you to own the policy along with the compounding cash value that's built within the policy. Remember that just paying the true cost of insurance is comparable to renting a term policy. With each successive purchase of a term policy, the cost of insurance increases, along with the risk of not being a candidate for the insurance company the next time you're ready to get another policy. This is associated with the probability of acquiring new diseases and illnesses over time. Keep in mind, most insurers will not commit to a new contract somewhere between the ages of 80 and 85, depending on the carrier, no matter how much money you throw at them.
Let's check this blood pressure. Hey, not too shabby. 130/80. I'm sure my doctor will be pretty happy with that. But do you mean to tell me that after this term is up, I'm going to have to go through another complete physical and blood test again?
After each term is up, a new health assessment, blood test, whatever other tests that are required by the insurance company must be done to see whether or not you're a candidate, and to acquire the best rates for your age given your current level of health. With a permanent life insurance policy, whether it be whole life, universal life, guaranteed universal life, or index universal life, you only have to undergo one health assessment to complete at the beginning of the contract. And that's it.
Since I'm getting a permanent policy, this will be the first and last time I have to undergo getting a physical exam, including the blood test, of course.
That's right. After passing your initial exam, you don't have to worry about the risk of developing a disease or condition, becoming too overweight, or simply not qualifying because these are factored into your premiums. If, of course, you qualify under the initial health exam, of course. With whole life, you are guaranteed the tax-free death benefit, a level premium, along with all the compounding savings components inside the policy, known as your cash values, which can be utilized tax-free as well if done properly. But if you were unable to make premium payments later in life, or didn't structure the payment so that it was paid off by a certain time frame, some folks were lapsing their policies. I compare this to being in over your head with a mortgage. Maybe you chose to buy a home that was well out of your price range, but you decided to do it anyway. Upon the fruition of a universal life policy, policyholders were no longer subject to the rigid payment structures previously defined by a whole life policy. The shift in design allowed policyholders to make adjustments throughout the life of the policy. For example, if an owner had difficulty making premium payments, they could adjust the death benefit down, or even miss some premium payments into their policies. This was like having the ability to lower the base cost of insurance by reducing the overall death benefit. In addition, the policy remained permanent, so no ongoing health assessments were necessary. And this, of course, unbundled much of the risk the insurers normally managed and placed that risk into the hands of the policyholder. By doing so, the insured's premiums were significantly less than that of a whole life policy, and the interest credited to the side account was subject to change with the potential for higher growth. but at the same time, the possibility for less interest growth, which could affect policy owner's principal. If you haven't watched my previous video on universal life, this would be a good time to stop and review it and understand the pros and cons of owning one. Many policy owners were intrigued by not having to pay a higher premium for the same death benefit as they would with a whole life policy. They enjoyed the growth of their policies performed at, for a time, until of course they didn't. Being that the side account was tied to the form of interest stipulated in the contract, which was subject to change, many policyholders would pay the least amount of premiums into their policies rather than on the higher end and the earlier building years of the policy, which is the exact opposite of what you should be doing for any permanent policy if your focus is on compounding effectively. With the cost of insurance growing in the later unhealthier years of life, the hope is that the interest growth compounding in the side account will remain high enough to cover this expense. But since insurers place this risk in the hands of the policyholders, an underperforming policy could emerge over time, especially if it wasn't funded properly and the interest credited had the ability to fluctuate to a less than optimal rate. Actively managing your universal life policy includes the risk of a fluctuating yield to the side account. Imagine paying into your policy every year as stipulated in the contract for decades, and then having a surprise increase in premiums because the side account didn't maintain a large enough reserve. Again, you could lower the death benefit, cut some of the administrative costs, thereby lowering your base cost of insurance. But if you chose to not pay the increase or make some of these adjustments along the way, you might be better off just cashing out your policy. If you wait too long and your only hope is the interest rate to adjust back upward, you could be fooling yourself, and a policy like this could lapse due to mortality table increases. The reality is that these permanent policyholders, the ones whose policies lapsed, were sold a universal life policy with the intent of paying less for the same death benefit as they would for a whole life policy. And that's it. In other words, all they saw when purchasing the policy was a smaller price tag without understanding the risks associated with actively managing their own policy. People who want the cheaper cost for a permanent policy with a guaranteed death benefit and don't want to concern themselves with managing the ups and downs, nor care about any sort of compounding growth in a side account, they need a different form of insurance altogether. Shortly after the emergence of universal life insurance, that need would be filled with the creation of guaranteed universal life insurance. Now, the risks associated with owning one are minimal, and the reason I place it lower on the continuum, yet to the left of the whole life policy, is because you need to agree to the terms that stretch out the guaranteed death benefit from age 100 to 120, which I'll get into shortly.
Why guaranteed universal life?
Guaranteed universal life insurance is a type of a permanent policy where you pay just beyond the cost of insurance, and the premiums are generally less expensive than that of a universal life policy. The reason for this is because the interest yield tied to the cash value side account is fixed. When the interest rate is fixed, the insurance company doesn't have to actively manage any fluctuations which are based on the underlying performance of the investment portfolio of the insurance carrier as a whole. When the carrier feels comfortable guaranteeing a minimal interest yield to the side account, which could otherwise perform better when actively managed, the carrier can exchange that fixed interest rate for a guaranteed death benefit. Now, this is really all a guaranteed universal life insurance policy owner really cares about. The cheapest form of permanent insurance that is integral to estate planning just like any other form of permanent insurance, and guarantees a tax-free death benefit for ultimately a better overall cost. I like to think of guaranteed universal life insurance as the next best thing that is stringing together multiple term policies over a person's lifetime, whose focus is really only on the death benefit protection and not on any living benefits, such as a tax-free compounding growth in cash values. Now, if you recall, no insurer will insure anyone after between that ages around 80 to 85, no matter how much money you throw at them. In addition, with regards to term insurance, you also have those continual health exams after each term is up that you have to undergo that you might or might not pass. I essentially like to compare this to trying to purchase car insurance for a car that's already been in a car accident. Except the car that you're trying to insure in this case is your body. But here's the thing. This isn't car insurance. This is life insurance. Keep in mind, insurers really only want to insure the cars that are essentially in mint condition. And the reason for this is that they know that the owners really care about the car, right? And they really, and they're going to continually perform all the necessary upkeep to keep the car in good working order and looking really good and running smoothly, right? So if you were to think about that with your body, a person who has continual checkups and is aware of their degree of health and is continually doing what they can to stay as healthy as possible, those are the types of people that the life insurance companies want to work with. So a person who continually has an annual exam from their primary caretaker will actually know if they're a good candidate or not. That's why I keep harping on the fact that you should really consider permanent life insurance in one of its various forms while you're young and healthy, so that you can pass that initial exam and never have to worry about it ever again. Now, the thing about guaranteed universal life insurance is that it arose out of the building blocks of universal life, which, if you recall, put the risk in the owner's hands. Now, to add back the guarantees into a guaranteed universal life contract, the risk would have to be shifted back to the insurance company. We did this by offering a low fixed rate to the side account, which was easily managed by the carrier, and by offering to extend the contract from age 100 to 120, which was totally up to the insured. Unless the current guaranteed universal life policy expressly covers this difference in time. I myself have never seen a policy indemnify if you outlive it, but stretching out the death benefit from age 100 to 120 for a slightly higher premium will more than likely ensure the guaranteed death benefit, as the probability for people living past that age in this century tends to increase as medicine and technology continues to get better and better and better. Since the insurer is now taking on the risk of providing a guaranteed death benefit through a fixed low interest rate and cash values, the cash values built inside of the policy are going to grow very, very slowly, and the compounding effects will be very, very minimal. Just enough to cover the cost of insurance as we age, with very little wiggle room for the compounding effect to take place. So much so that if you were ever to borrow or take out a loan against the cash values in a guaranteed universal life insurance policy, you're essentially voiding the contractual guarantees, which is the primary reason for why one purchases a guaranteed universal life contract in the first place. So in essence, if one chooses to borrow from this type of permanent policy, this policy could essentially lapse. So borrowing on a guaranteed universal life policy is not recommended. If you want to give yourself the ability to accrue compounding interest for the purpose of living benefits and a death benefit, you should consider other forms of permanent insurance altogether. Just think of a guaranteed universal life policy as a lifelong term policy that's guaranteed to pay out the death benefit upon the insured's death, with the option of extending the policy out to age 120, if you so choose, with all of its available riders, of course. So, if you've seen enough and don't really care about building any cash values, but really want to see a guaranteed death benefit paid out to your beneficiaries, contingent beneficiaries, that works just as well in estate plan as any other permanent policy, no matter how old or unhealthy you become later in life, owning a guaranteed universal life policy is one of the cheapest forms of assuring that form of protection. Now, if you'd like to look into acquiring a guaranteed universal life policy and want to do it on your own time without any pushy salesman breathing down your neck, please take a look at my quote and apply platform somewhere in this description of this video. I'm currently representing numerous different carriers in the states of New York, Virginia, and Florida. Now, all you have to do is answer some very basic questions regarding your age, your height, your weight, any known conditions that you might have, and voila, you can compare and contrast rates between numerous different carriers, between different types of life insurance, and you can do it from the comfort of your own home. If you like what you see, you can fill up an application form for that particular carrier right then and there. You can then set the date for the medical professional to come out and see you and draw your blood and perform any other tests that the insurance company might require of you based on some of your answers that you in your application, at a location of your choice and time, and keep in mind that this blood test and any other tests that are required will be covered under your first year's premium. So you'll have to make that initial payment, whether it be monthly or annually, before the medical professional will come out to see you. And don't worry, you won't be sending your money to some guy that you just saw on YouTube or on some video like me. The money will be directed directly to the carrier. So, for example, if you wrote a check out for X amount of money, it will show up in your statement as such under the carrier's branding. Now, during this time frame, the insurance company will offer you what is called a conditional receipt, and as they assess the medical exam, after the analysis is complete, the premiums will then be adjusted up or down in relation to their findings. Now, keep in mind, many people think that they're healthier than they actually are. So, as you, the owner of the contract, you'll have the opportunity to either accept an increase in premium or even a decrease. Often, times that happens more often than not. That it actually becomes cheaper than they originally showed you. But again, that's all dependent on your health. Now, if you can't afford the rate hike, and you can either adjust the death benefit down a little bit or try a different form of coverage altogether. All in all, if it doesn't make sense, you can choose to not acquire the policy altogether. If the terms are accepted between you and the carrier, you will receive a follow-up onboarding email confirming the transaction from the carrier. If you don't like the new terms, you'll receive all of your first initial premium back in a timely manner and won't have to pay for a cent of the initial exam. That's essentially the price of doing business from the insurance company's perspective. So if you're ready to move forward, what's holding you back? You're not getting any younger, and with each day that goes by, the cost of insurance incrementally is increasing. So lock in your rate now while you're healthy and haven't become too overweight or on too many medications or developed some uninsurable disease. And if you at any time have questions or concerns, please email me. Let's see if we can work together, and I'll help place you in the proper plan. And as I said before in my previous videos, with the war in Ukraine, many Russian elites who have been sanctioned by our government might be looking for ways to fraudulently grow their wealth by using a life insurance policy, for example. Just know that I'll be looking at the ISIJ investigations list to see if your name is on that list. So essentially, if you're an oligarch, please don't even bother. As the agent of record, I will not be signing off on that policy. But for the rest of my fellow Americans, and legally green-carded individuals living in the states of New York, Virginia, and Florida, please check out my Quote and Apply platform and acquire the proper insurance to fit your needs. And remember, whatever plan A you decide on, just keep climbing. No one can walk in your shoes but you. I hope this video has given you some good insight regarding the purchase of a guaranteed universal life policy. And if you want more of this type of information, please like this video. And if you want to continuously see this mug, please subscribe. I hope that you and your family have a wonderful rest of your day. Goodbye and take care.